What if you had not just one, not just two, but three different sources of income that could be used to turbocharge you towards your financial goals in the future? If that's something that's somewhat interesting to you, even a little bit interesting to you, stay tuned. So you made your money. Now what? Welcome back to your virtual family office. My name is Teron Stokes. Here we focus on ways to master your money and build a legacy. And today we'll be focusing on three primary sources of income. Well, let me take that back. Three sole sources of income that are available to you here specifically in the United States. That's going to be earned income or ordinary income. That's going to be portfolio income as well as passive income. Each one of these sources of income have their own taxation attributed to them, and each one has their own different definition as to what each one is. And for most of us, we're going to be starting with earned income. This is going to be your W-2 income, your salary, or tips. This is going to be something that you're going to use a lot of your personal energy and time to acquire. As we move up the ladder, shout out to Mr. Kiyosaki, who made this idea well known. But as we move up to the different sources of income, you'll see that there's different trade-offs that are necessary to acquire them. So let's start first things first. This is going to be for ordinary income, and this is going to be income generated from active trade or business. Think of 9 to 5, then you clock in, clock out. So we're actively using our time and energy to acquire this money. This money is going to be heavily taxed, as we're all aware. When we first get the job, we talk about gross income, but that's an income that we never see, and it's quite gross that they even tell us about this income because we never see it. And so that's going to be earned income or active income based on the IRS. And that's going to be taxed at the highest, anywhere from 10 to about 37%. However, it's the income that we're first going to acquire, and it can also serve as the income that's necessary to generate the other two forms of income, being portfolio and passive income. So let's not be too mad at it. It's just all about how long we spend at this level of income generation. And active income also is not just W-2 income. For my self-employed entrepreneurs and business people out there, you too are getting hit with active income. So long as you're actively working toward that income, whether you're in a service-based business or a product-based business, if you are spending time working in the business, then you are also going to be receiving active income that's also going to be taxed at a higher rate. Ordinary income is, of all three sources of income, is going to be taxed the heaviest. However, relatively speaking, 37% is not even the highest tax rate that used to be levied on taxpayers. We have historical income tax rates. It was created in 1861. During the Civil War, there was a flat tax that was repealed in 1872. Income tax brackets didn't exist prior to 1913. With the ratification of the 16th Amendment, passage of the 1913 Revenue Act. But at that time, the top individual marginal income tax rate tended to increase over time through early 1960s. But let's skip over that. The top income tax rate reached above 90% from 1944 to 1963, peaking at 1944. Taxpayer paid an income tax rate of 94% on their taxable income. And so I read that not only because I'm a history buff, but also because, 37% is insanely high when compared to the other forms of income. There was a time when the United States absolutely lost their mind when it comes to taxing those who are actively working to generate income to support themselves. But I digress. The primary reason for that is just for historical reference. But here, we're definitely interested in paying as few taxes as possible, legally, of course, on this channel. When we look at portfolio income, we do have to pay attention to passive activity rules post 1986. And so portfolio income, this gives us our definition for the different portfolio and active income, so that it becomes very clear which bucket you're in, so that you can understand how much you should be expecting to pay in taxes. And so portfolio income is income derived from investments in capital, interest, dividends, capital gains, and forms of portfolio income. Some forms of portfolio income, such as interest, annuity payments, royalties, short-term capital gains, and non-qualified dividends, are subject to ordinary tax rates. And so that's very important. You can have portfolio income, but there are sources of portfolio income that you're not actively working in that are still going to be taxed as ordinary income. The most prevalent one, especially those who are investing in the stock market, is going to be the short-term capital gains, which is anything less than a year and a day. Remember that if you've had the stock for less than a year and a day, you're going to be in ordinary tax income, and you're going to be looking at potentially as high as 37% if you fit in that bracket. but royalties as well as non-qualified dividends also fall in that bucket, so be careful there. Other types of portfolio income, such as qualified dividends and long-term capital gains, are taxed at more favorable income tax rates. And so that's going to be the max of 20%. Think about it. If you invest in a stock, that's a stock that's going to be trading all the days that the market is open, and you're not actively involved in that income or revenue generation of the company that you're invested in. And so any capital gains that you receive, any qualified dividends that you receive from the result of that company are taxed at 20%. And so we're already seeing the importance here. When you're starting to think in terms of generating wealth, you're going to want, of course, we're going to start at ordinary income. The majority of us will, but it's all about how quickly can I shift out of this ordinary income and move into something like a portfolio and even a passive income opportunity, so that I can start acquiring wealth. So switching over to the final and last of the three sources of income is going to be your passive income. And so income and trade a business in which the taxpayer does not materially participate in the business. Unlike portfolio income, passive income implies that the investor is receiving the fruits of labor. But in this case, investor is receiving the fruits of somebody else's labor. Classic examples are going to be, investments that generate passive income from limited partnerships, S corporations, LLCs, and real estate. That's a crucial one there. So I keep talking about material participation, which is very important when you're looking at the three different sources of income, specifically between income that's active and income that's passive. And so material participation requires involvement in the conduct of trade or business in a regular, continuous, and substantial basis. Mere management approval of decisions made by others does not constitute material participation. So you can have an LLC, for example, that somebody else is actually running and managing, but if you're making high-level decisions in terms of, like, say, strategic movements for the company, that's not necessarily considered material participation. But the IRS does provide a little more detail into what material participation means, so that we can be very clear. And so, one, the taxpayer dedicates more than 500 hours of effort to the activity each year. The taxpayer dedicates more than 100 hours to activity, but no less than anyone else. Taxpayer dedication more than 100 hours to each of several activities and more than 500 in total of these activities, not including any activity for which the taxpayer is a material participant. All a mouthful, but what it's saying is 500 hours is the watermark. You don't want to surpass 500 hours dealing with this LLC, S Corp, or you're going to be considered actively working or actively participating in the venture, which means now you're going to be actively taxed. If you're looking at these three different sources of income, you want to pay very, very close attention to how the IRS defines them, looking at the passive activity rules post 1986, which separates the three different incomes between active, portfolio, as well as passive. And so to give a summary of this video, I know this is a short one, straight to the point, but I think it's very important because when you start thinking in the way of an entrepreneur and business person as well as an investor, you want to understand the three different ways that you can, one, generate income, but you also want to know how much income you're going to be expected to pay to the IRS. Again, it's not about how much you make, it's how much you keep. And so between these three sources of income, earned income or active income, you're going to be taxed the absolute highest. But for many of us, that's where we're getting started. So there's no shame in that. It's really about how quickly can you pivot to the other forms of income. And moving to your second one, which is your portfolio income. Now this income is going to be max 20%. This is going to be the most you're going to pay. And the amount of energy that you're spending to generate this income is going to be significantly lower. And so now we're starting to move over into the wealth generation and long-term thinking, because not to mention that this is something you're not actively working in. This is also something when it comes to building a legacy that you can pass on to your loved ones. And the third one is going to be passive income. Now, this is going to be the way that a lot of wealth is generated. In portfolio income, you do see that, but now you get to a point where you're not materially participating in a business that can then generate an unlimited amount of money. Now you're starting to get into really wealthy territory. I really hope you guys gained some value from this episode. It's really important when we look at the three different forms of income, being active, portfolio, and passive, each of which are important in their own way. When we begin talking about wealth and generating wealth, we really want to focus primarily on the portfolio and passive income. If you guys really enjoyed this video, and I'm going to do one better, look in the description below. I'm going to have a cheat sheet that's going to go over the three sources of income, but you're going to have something when you walk away from this video. Again, my goal here is to provide as much value as possible here at your virtual family office when we focus on ways to manage your money and build a legacy. My name is Teron, and I definitely hope to see you in the next one. Take care.